Good day, everyone. I'm Irish Joy Villanueva, who will be reporting about the parts 4 to 6 of Chapter 11. I will have 6 talking points. Topic 1. Cost of capital. The cost of capital can be considered from both the demand and supply points of view. It represents the cost of raising funds for investment as far as the firm is concerned, and it also represents the rate of return required by the providers of these funds. So we have debt and we have equity as the cost of the company's funds. So logically, we're studying this because for an investment to be worthwhile, the expected return on capital must be greater than the cost of capital. Topic 2. The cost of debt. Utang. Pros for this kind of cost is that debt is less costly in the form of financing for your business, and you do not give up any control of your company, unlike equity. Topic 3. Cost of equity. You give up a portion of your company or the control in the form of shares, so you issue shares. And stockholders share in the profit and, of course, failure. For sources of equity, we have internal and external. For internal sources, we have the retained earnings, reserves, surplus in a reference book. It also covers the capital asset valuation model or CAPM, the capital asset pricing model, which describes the relationship between systematic risk and expected return for assets, particularly stocks. CAPM is widely used throughout finance for pricing risky securities and generating expected returns for assets given the risk of those assets and cost of capital. So in the formula, you will see values for risk-free rate of return, risk-free premium, and beta. Risk-free rate of return is the value assigned for an investment that guarantees a return with zero risks. Market risk premium, on the other hand, is the expected return an investor receives or expects to receive in the future from holding a risk-laden portfolio instead of a risk-free asset. The beta is the measure of volatility of that stock concerning the market in general. Next, under internal sources is the dividend valuation model or the DVM. Just look at the formula and you will see that it covers D for dividend and V for value. The value of a shareholder's wealth is the sum of expected future returns discounted by their required rate of return. These returns come in the form of dividends and an increase in the market value of the firm shares. The dividend valuation model is often referred to as a dividend discount model. To determine the value of a stock, this valuation model uses future dividends to create a prediction on share values. It is based on the sole idea that investors are purchasing that stock to receive dividends. What else? So, moving on to another source, the external, an example of which will be the issuance of new shares. Very self-explanatory in a way. Which brings us to the next topic, topic 4. Weighted average cost or capital or WACC or WACC. As you can see in the illustration, it is a balance of the sources of capital that we have just discussed. It is the rate that a company is expected to pay on average to all its security holders to finance its assets. It is calculated taking into account the relative weights of each component, D for debt and E for equity. Each has a different cost. A firm therefore needs to estimate the weighted average of these costs of capital. Topic 5. Evaluation criteria. Now that the methods for estimating the cost of capital have been examined, we can now consider how the cost of capital is relevant in the capital budgeting process. Ultimately, managers must decide whether to invest in new projects or not. Once the preliminary stages of estimating the cash flows, assessing the relevant risks, and estimating the cost of capital have been performed, some criterion or decision rule must be applied in making the investment decision. There are two main criteria that can be used here: net present value and internal rate of return. Topic 5.1. What is net present value? This method takes the time value of money, which is the net present value of the future money, then add up today's cash flows, which will be negative because the money is going out, and the present value of the future cash flows, which is positive because you expect them cash flows to come in. If the NPV is positive, then go ang project. We pursue it. The following is an example of the NPV calculation where you can see the outflow for the first year and the projected nga kita for the succeeding years. Notice that we are adding the present and not the future values, hence the net present values. We see the result is 35, so okay ni negosyo. By the way, I got this from YouTube channel The Finance Storyteller, so I give him credits for this illustration. Topic 5.2 is just simply NPV at 0, which is IRR, and we compute which discount rate that happens. Using the same project earlier, we get the IRR of 22%, which exceeds WACC of 20%. Is that good? Of course! So topic 5.3, evaluation criteria. We compare both and realize that both can be very, very useful for decision making, except that IRR cannot be used for different discount rates. Duh! Kasi isa lang yung discount rate niya, and really not appropriate for mutually exclusive projects. We have an example of various projects here. The first one has constant returns. The second has decreasing returns or nagagamay iyang kita through the years. And the third, nagadako ang kita. So, dugay ang balik. If you look at the evaluation results, turns out, pangit ang ikatulo kay dugay lagi kabawi. And negative pag yun ang net present value. While the best ang second project kay nabawi na dayon plus taas pa jud ang internal rate of return. Evaluation criteria also covers briefly other methods like payback method, discounted payback, profitability index, modified internal rate of return, decision-making under risk, decision-making under certainty. So topic 5.4.1, the payback method evaluates how long it will take to pay back or recover the initial investment. The payback period, typically stated in years, is the time it takes to generate enough cash receipts from an investment to cover the cash outflows for the investment. Kano sa ba ang balik sa imong kwarta? Topic 5.4.2, discounted payback. It's essentially similar to the payback method, except that there is the cash flows are discounted at the cost of capital. So, mas complicated gamay. Topic 4.3, profitability index, where that index should be greater than 1 and the present value of the benefits exceeds the present value of the costs. Obviously. 5.4.4 is the modified IRR. It is a modification because it is an NPV of the inflows or cash that should be equal to outflows, which versus IR, where all the cash flows from a project becomes 0. It is much more precise than internal rate of return. So topic 5.4.5 is decision making under risk. Note the risk word. There, it means uncertain and the element of chance is considered, and the decision maker has incomplete information about available alternatives but has a good idea of the probability of outcomes for each alternative. Moving on to decision making under certainty is, in contrast to uncertainty, the parameters are known and or assumed to be, and the decision maker knows with reasonable certainty that the alternatives are and what conditions are associated with each alternative, as well as the outcome of each alternative. Topic 5.5, optimal capital budget. It is estimated by calculating the mix of debt and equity that minimizes weighted average cost of capital or WACC of a company while maximizing its market value. An optimal capital structure is the best mix of debt and equity financing that maximizes the company's market value while minimizing its cost of capital. The book has enumerated the following points: the investment opportunity schedule, and the marginal cost of capital schedule, and the equilibrium of the two. topic 6.1, the IO schedule. So it's a schedule or a list of investments arranged from highest to lowest in relation to its IRR, and based on the table, the company is most likely to select the one with a higher IRR as their main goal, since maximum profit siya, and it is the process of prioritizing the investments for the company. And since it's a schedule, it can also be turned into a graph. Note that. Topic 6.2, the marginal cost of capital schedule, is a graph which relates to the firm's weighted average of each dollar or peso of capital to the total amount of new capital raised. It increases by steps. So, steps na inyong kita nga drawing, diba? The amount required to borrow up a certain amount is constant. As the company borrows more money, the interest charged will also rise. Obviously, no? Topic 6.3 is the equilibrium of the two graphs, the IO and the MCC, and the intersections are important because they reflect the optimal points. The optimal capital budget and the cost of capital are given by those intersection of the IO and MCC curves. So to summarize, the cost of capital can be considered from both the demand and supply points of view. It represents the cost of raising funds for investment as far as the firm is concerned, and it also represents the rate of return required by the providers of these funds. Why would you provide kung di naman lang ka mabalikan, no? The two main components of long-term funds for number 2 are investment and debt and equity, and each has a different cost. The firm therefore needs to estimate the weighted average of these costs of capital. Remember, ang kapital ug ang inutang, they both consider the assets. There are two main evaluation criteria that are applied to capital budgeting situations. That's NPV and IRR. The former is a better measure since any project with a positive NPV is expected to increase shareholder value. However, number 4, managers still often prefer the IRR measure since it is expressed as interest rate and can make for easier comparisons between projects. Lastly, number 5, it is important for managers to estimate the optimal capital budget for the firm. This indicates the total amount that should be spent on capital projects and can only be estimated simultaneously with the cost of capital when the demand or the IO and the supplier MCC schedules are combined. And that's it. I hope nakatudlo ko bisan gamay sa akong pagpamalandong aning libro. Char. Just kidding. Dili ko maangkon. Ilaning pamalandong. Pero atong tulunanan. This is Irish again. God bless and thank you.